So you want to invest in the stock market, but you've heard a lot of really good news from people making a lot of money overseas and in foreign countries. So you want to do that, but here are some things that you guys should know before you start investing overseas. Let's get into this right now. So investing in, we call it Forex, foreign exchange, investing in foreign countries and so on. There's a lot of things you need to know. I don't like to do it, but I know a lot of people that have made some money investing overseas. So here's some things that you guys need to know before you actually make your first trade overseas. We're going to do the very first thing here is you're probably going to want to look into the taxes. So I'll give you the example for what happens in Canada, but if you invest in a foreign country, even in the United States, and you're a Canadian citizen, now check whatever your country is, check these laws. But if you were to invest in a company that pays a 4% dividend, and it's from China or something, or United States, wherever, as soon as you get that dividend, there's actually a 15% withholding tax that you never get to see. So 15% of your money, of your dividend, just evaporates like that. There's a lot of that hidden stuff in the tax code in Canada. And so you're gonna have to check what that's like for your country. So for example, that 4% dividend, that nice sweet 4% dividend, that becomes more of a, 3.5% dividend. Again, it's probably not gonna affect you too much, but it's something for you guys to look into. Let's see what else we got here. Oh yeah, plus eligible and non-eligible dividends here. So again, this law applies to Canada. It might apply to your country, it might not. So there's these things called eligible versus non-eligible dividends. So eligible dividends are usually big, giant Canadian companies that Canada wants you to invest in. And so big, giant, especially Canadian banks, they will pay you eligible dividends where your tax rate is significantly lower than it would be for foreign dividends, for example. So the example I have here actually is for eligible dividends within the country, within your country, for the average person, they'll be taxed at 6%, your tax rate. So just for the average person. And if you were to invest in a non-eligible or a foreign company across the world, they're going to be taxed on average at about 18%. For a dividend specifically. So again, you're going to have to look into that for yourself, see if that's okay for you. There's also some gray areas for capital gains in foreign countries. Sometimes there's some withholding taxes for those too. But you're going to have to check that for your own country. So make sure you follow the tax code and know what's coming. Because I remember expecting a dividend from an American stock. This was 5 years ago. And I was like, wait, where is all of it? I didn't see all of it. And so there's actually a way to get around that. There is a way to get around that. I think that I will mention it at the very end because there's a way to get around a lot of these problems, which I will mention at the end of this video here. So we're going to mention the next thing you guys should know is fees. Specifically broker fees. So one of the reasons why, especially when I was younger and I was only investing $500 to $1,000 at a time, I didn't like investing overseas because of the fees. So for example, right now at my brokerage, for one trade, the broker, in order to execute that trade, will take a $7 to $10 commission. So it depends on if you're investing in the United States or Canada, but $7 to $10 on a $1,000 or $2,000 trade, like who cares, right? That's not too much money. But if you're making a $500 trade and the broker fee is $50, like it is when you invest overseas, that's a lot of money. That's 10% is going to the broker. So look at your fees in your brokerage account. Usually investing overseas, we're talking you're paying $50, $60, sometimes $40 just to make one trade. So look into that for you. It can be 5 times more expensive investing overseas for the broker fees as it is for you investing in your own country or a nearby country. Look at your fees. Make sure that you aren't too shocked like I have been before. Actually, I made that mistake recently. I made a trade recently, and the broker fee was like $30. And I was like, God damn it. We're going to move on to number 3 here. Number 3 is transparency. So if you invest in different countries and developing countries, a lot of them don't have the regulations for revealing their financial information as much as the United States or Canada or a developed country. So if you're going to a country and you're investing in a country like Brazil or China, or not even China, maybe China, I don't know how tight they are with that stuff, but companies may not have to give completely true, thorough reports on whatever their earnings are. So whatever country you're investing in, whatever exchange you're investing in, make sure that you have as much information on them as possible. That's actually the next thing I want to talk about, is information. Info. Information. Each country usually has a different amount of information they'll reveal to investors. So, for example, if you're investing in Apple, you can find a shit ton of information on them, about their entire company, about what the products they sell are, about their earnings, about where all of their money is going, how they spent $1 billion in whatever X expenses, how they put this much to research. They have a really thorough report. You can find a lot of information on them online. However, you might not be able to access information to foreign overseas countries. And I found this a bunch of times, especially with some Chinese companies I was looking at. You can't really find much. You can't find much. The companies are very tightly knit because they don't need to, again, they don't need to reveal as much information, I guess, for the most part, or it's just tougher to find. A lot of the times, if you're investing in an overseas country, they might not care as much about internet. Right? They might not care about their website. They might not care about, because they're so focused on the traditional way of investing. You know, person goes in, sends in the stock at the stock exchange, makes the trade in person. They don't really care too much about giving out information over the internet. So again, that's just one of the drawbacks that I have in investing overseas, is that it's tough to find information on a lot of those companies. And I guess, actually, we'll talk about, the one other thing too is that a lot of those companies, you know, luckily we have Google now, but to translate this stuff, but a lot of them don't even have English documents. So, I mean, if you speak English and the company has only whatever a Brazilian document, I don't know, is Brazilian a language? I don't even know. But if they only speak a Brazilian language and the document's all in Brazilian, you're going to have to translate that yourself if you want to invest in it and look into see what the company's actually doing. So, again, that's another barrier. Number 5 here is, let's see, instability. So the other ones we have mainly been instability. Sorry, there we go. The other ones, let's see, the first 2 have been money related. The next 2 have been information related. Instability is more of market related. And so usually the first 4, like people are like, it doesn't matter. I just look at charts and I buy the stock. Who gives a fuck, right? So this one's more about the market itself. So think about what happens in developing countries, in overseas countries. A lot of them are, I'm not talking about, because there's overseas countries, like there's, you know, a bunch of countries in Europe, like France, England, places like that, where you can put your money, everything's going to be usually fine. But usually most overseas investments that people think about are like China, Brazil, so on. So think about what those countries are like. A lot of those are not too stable for the most part. Like, we're going to mention Brazil specific. How about China specifically? I mean, they had their own stock market crash in like 2015, right? And they're supposed to be somewhat stable. They're supposed to be somewhat developed, right? But what I'm trying to say here is a lot of those developing overseas countries, they're really unstable countries. I mean, the governments could be unstable. In a lot of developing countries, the government isn't. I mean, look at what happened in it's a South American country. The economy completely collapsed there within 2 years. I forget what country it is. Is it Venezuela? I forget what country it is, but still, like, you have to take that into account. Are you willing to, there's extra risk versus investing in the United States for the most part. Because sure, the stock market might crash in the United States. However, the government's not going to fall like tomorrow. In other countries, it might. Is it worth the risk? So that's something for you guys to think about. I'll talk about the way to get around this stuff, most of it. One other thing I wanted to mention before I get to that was, like, you can have really good returns. I'm really, like, this is just a warning video, I guess, about what to think about before investing overseas. But again, if all these go well, you can have much higher returns than in the United States. I mean, we're seeing growth of like, what, 4, 5, 6% in some developing countries. And in the United States, it's closer to 2%. So again, you can have very good returns, but these are just warnings here. So one of the ways that you can get around a lot of this stuff a lot of this stuff is actually, I'll just put it up here, a domestic ETF. So I'll talk about how this applies to all of this stuff here. So you want to invest in like a Chinese bank company, okay? You want to invest in a Chinese bank company, but it's risky. This bank has had some problems. You don't have a lot of information about it. It's worth investing in the entire banking sector in China if you really wanted to, through a domestic ETF. So for example, I'll give you my example here. If I wanted to invest in an American, I've invested in American ETFs before, so an American ETF, but the company that set up the ETF is Canadian, meaning that all the taxes are all going to be from a Canadian domestic company, so I'm going to get all those tax breaks. Okay, the fees, I'm investing in a Canadian company, so the broker commission is only going to be for a Canadian company, which is $7. Transparency and information, I mean, I guess that's roughly the same thing. Stability, I mean, you're not putting all your eggs in one basket, in one foreign company, okay? So, again, this is something for you guys to look into. It might be worth it, but domestic ETFs in foreign countries, that invest in foreign countries, I think that's probably the best route to go, especially if you're a beginner in the stock market. So for example, if you want to invest, in the Chinese banking sector, get a Canadian ETF that invests in the Chinese banking sector. And they'll probably know what, and again, the other thing too to offset some of this risk is that they can make some of those if it's somewhat actively managed, they can diversify your risk. So for example, if one banking company is taking a crapper, they'll diversify the ETF portfolio so that they sell off a lot of that stock and put more in the banking companies that are doing well, if that makes sense. So again, this is just a general overview, but this is what I think about when I invest overseas. It's a little bit more, it's problematic, I guess. I tend to stay away from it for the most part. I think I might have actually only invested in a foreign country. Well, I have invested at least once American companies I don't consider really foreign, but I think I've only invested in overseas once, probably. I think I was really, really young. I just wanted to see what would happen. Then I think I just sold the stock right away. It went up a little bit and I just sold it, took a loss. Just wanted to see what would happen. I think, I'm not 100% sure though. I mean, I was 18 when I was looking into this stuff. This was like almost 5-6 years ago now. So what I recommend investing overseas, I would say look into it. Don't, you can base your investment simply on charts in the United States, in Canada, England, France, wherever you're from, if you're in a developed country, but you can't do that in developing countries a lot of the times. It's really, really risky. So try to look into the companies, try to find as much information on them as you can, and just take into account all the tax implications and the fees that come along with it. So if you're interested in me doing some stock breakdowns and some stock market, you want to see what my portfolio's like, check out the stock market program in the link below. Teaches you from knowing nothing about the stock market to making your first trade. Plus, I'm updating it so that I will give stock breakdowns essentially a few times a week. And I'll tell you what I'm buying, how much I'm buying, where I'm buying it, and so on. So yeah, it's been going really well so far. So anyways, check that out in the link below. You were all very beautiful people, and I'll see you guys in the next video.